Welcome back, folks, for another FEX Insights, episode number 13. We've got some really interesting news as well as a special guest coming on later on. We're diving deeper into the world of tokenized assets, stablecoins, and much more, especially how blockchain rails change everything. We'll see you soon. First up in the news is this article from the Financial Times. So given that Trump's America, corporate USA is looking to be more positive on the crypto space, there was a whole lot of talk last week with regards to how crypto is now going to be something that can be invested in retirement plans. So here's a Financial Times article. It's a transcript actually from a conversation between Brooke Masters, Sujit Indap, Elizabeth DeFontenay, and Joe Miller. And so there's the audio transcript to a podcast. You can certainly listen to the podcast. And they talk about, interesting here. It's Mark Filipino. I'm Filipino by background, so I've never seen a name like that, but that is a pretty damn cool. But yeah, they spoke about President Trump handing two huge industries a massive win with regards to private equity and crypto, opening up to trillions of dollars in new investments. So paving the way to make it easier for private investors to basically be able to get access to things that were traditionally just there for institutions. So further down, they talk about the executive order, what it did. They speak about the studies that one of the professors has done in the space and what the reactions were from people. So Elizabeth said that the industry has been pushing for quite a long time. There was already a sense that the administration was very receptive to this, and so it didn't come as a surprise, but it did come as a bit of a shock in the sense that many people, including people in the industry, don't think that this is going to be a great idea for people's retirement portfolios. Potentially that's due to the volatility in the space, the need for, especially here in Australia, we have the high net worth test. So if you are earning over a certain amount of money, or you've got over a certain amount of money in your assets, then it's okay for you to invest in certain things, but otherwise it is not. And that's purely from an educational point of view, as well as the wealth that you have, assuming that people that have more wealth can afford more investment advice. So really interesting to see that they're also thinking about this sort of thing there as well. People should care because it's definitely been hard for retail investors to pick high performing funds when they do actually have a choice in the matter. So yeah, a lot of people don't realize it, but they are actually investors themselves when it comes to superannuation, what we call our pension funds here in Australia. So you don't get much choice apart from picking the fund over what it is that the fund does. So that granular choice, opening that up could be a whole world of hurt potentially, but given the hope that there are tools out there that will help people manage risk, understand what is going on, alert them to things, hopefully this does not turn into a casino where we know the house always wins, but rather a more, not safer, but let's call it opening up to interesting opportunities. Like there's definitely more risk when it comes to this stuff. Let's not deny that. But if it can be done in a way where the insights are shared with people and they can make more decisive or more educated decisions, I think that that's going to be a lot better. Whether that will happen here is being spoken about. We see the crypto space diving into SMSFs and investing there. But all risk, we'll see what the rewards are. Very interesting stuff, and you can read the transcript here. The next one is this MarketWatch article talking about tokenized stocks. So it says here, the heading, turning stocks and bonds into crypto-style trades won't be happening soon. Here's why. And then the article highlights that whilst there's been a growing buzz about the bold idea to change how Wall Street works, with the idea being that if we move all stocks and bonds onto a blockchain or create digital versions of them that can be traded using the same type of technology that powers crypto, supporters are saying in this article that this could make markets more efficient by speeding up transactions, lowering costs, and expanding access for investors. But turning that vision into a reality may still be a long way off. And they say here that a widespread shift from the current trading system to an exclusive blockchain-based system would be a real paradigm shift that would require up and down issuers, intermediaries, basically all stakeholders throughout the whole securities trading ecosystem, I think that would take a lot of time to develop the right systems to put into place. So says Mark Rodder, Capital Markets Counsel at the law firm Ropes and Gray. There's a lot of talk about this. We spoke about it recently on FEX, on Red Belly Insights, which is another podcast that we do. And what was interesting and highlighted there was the fact that there are folks like the Australian Bond Exchange that are doing things in this space, and they are looking to blockchain as part of Project Acacia to make more efficient how they do things when it comes to fixed income. There's a lot of delays that go on in that space. So certainly there's going to be a lot of the efficiencies that are highlighted. Now, whether or not it is industry-wide spread is another question, but to think that something's just going to change completely is another story. What a lot of people are doing in the space is actually just looking to make blockchain work via APIs and make it so that it's something that is interoperable with existing systems. So it's not just replacing, switching one off and turning another on, but it's more about like, how do you gradually make these replacements? So some interesting stuff in this MarketWatch article. Next bit of news here is this Investopedia article on stablecoins. So it's been the summer of stablecoins. Goldman says, will traditional finance be upended? We've seen in the past that stablecoins used to be the remit mostly of retail traders, but it's changed with more than 50% or what they call the flippening happening, with more instos being the ones that have higher usage of stablecoins. And when you think about that, it makes a whole lot of sense for international trade, for just national kind of transfers and just doing business thanks to stablecoins and the programmability that blockchain provides. So the article says here that roughly $270 billion of global stablecoin market stands to disrupt the traditional financial services industry, but to what degree remains an open question, certainly. Goldman says that concerns about the potential disintermediation of companies that provide payment and remittance services are overdone, so they think it's overhyped there. Firm sees Circle's USDC taking greater share of the stablecoin market at the expense of Tether's offshore USDT, so a question of trust. So further down in the article, they also highlight that there's a risk to remittance players, including places like Remitly and Western Union. They reckon that that is exaggerated according to the report. Sounds like a challenge to the crypto space, who certainly want to challenge the traditional players there. Goldman thinks that the Genius Act's compliant stablecoins such as Circle's USDC will take a greater share at the expense of USDT. The firm sees $77 billion of growth in USDC, and considering that it's a company that's IPO'd, certainly worth looking at. So if you think that that is true or not, would love your opinions on that. I certainly think that there's a lot more room in the space, and it may not just be from the fact that there's these companies that are coming in and overtaking what the PayPals and Western Unions do, but maybe it's the fact that Western Unions and PayPals and Stripes and existing payment remittance providers are going into the blockchain space themselves. We see that with Stripe, we've seen that with others like PayPal issuing their own stablecoins and more. So the war is on for digital payments. In other news, it's all about IPOs, and we see this one from Axios Crypto talking about Gemini's IPO. So crypto exchange Gemini is moving to go public despite declining revenue and wider losses in the first half of 2025. Nothing like a good IPO to provide some good news and stem those outflows, eh? Why it matters, the offering will test whether the momentum from Bullish and Circle, who recently IPO'd, and we've covered in this news, provides coattails to appear with weaker fundamentals. We will see an S1 filed, which is what you need. The S1 forms are what you need to file with the SEC when you're going to list. Late Friday, the crypto exchange founded by the Winklevoss twins reported $68.6 million in revenue, $282.5 million in net loss in the first half of 2025, compared with 74.3 in the same period in 2024. So year-on-year earnings there going negative. Gemini posted a revenue of $33.3 million in the second quarter, down 5.5% from the same period a year earlier. Net losses grew 375%. So really interesting stuff. IPOs, we will see whether or not it is able to ride the wave. But yeah, more on that in this Axios article. Now over to Asia with the Reuters article here on Asia's wealthy investors seeking more crypto in portfolios. The summary is that funds receive more inquiries, platform trade volumes are surging, and some family offices eye crypto exposure around 5% of portfolios. Hong Kong stablecoin legislation, the US Genius Act, and other things are fueling demand, especially with Bitcoin climbing to new highs of $124,000 in August and predicted to get to as high as $200,000 by the end of the year. It's certainly easy to see why family offices are looking at this sort of stuff. So as the Reuters article highlights here that some folks like Jason Huang of Next Gen Digital Ventures raised over $100 million in just a few months, and the response from LPs has been encouraging. So more on that sort of stuff is in this article. We see the same sort of thing here in Australia. Global news is news that is certainly reaching folks that are looking to invest, diversify, and whatnot. You can see more on that in this Reuters article. Another article here from a news provider we don't typically cover, but WRAL News, Crypto's Maturation in 2025. They say that ETFs drive institutional flows, RWAs are bridging DeFi, and AI is forging new frontiers. The cryptocurrency market in 2025 is undergoing a profound transformation, shedding its nascent image to emerge as a more mature and integrated component of the financial landscape. Very interesting point there, because if you compare it to when we first started in 2021, late 2021, working on projects, the news about this space and even thinking about or considering traditional financial institutions adoption was a lot harder to fathom back then. And just seeing how things have changed, it's always one of those things where, sure, there's a long way to go, but when you see the progress of what you've just been able to do over 6 months, over a year, over years, it is really hard to deny that there's been a lot of great progress. Institutional floodgates are opening. Yes, ETFs, RWAs, and AI's ascendancy. I remember the news about how long it would take to get a spot Bitcoin ETF. And when those floodgates opened, just the flood of funds or assets under management really growing in the US and here in Australia really took off. So BlackRock is mentioned here, spot Bitcoin ETFs, Fidelity and others, $812 million of net outflows in August 2025. Institutional demand has largely remained robust despite that recent outflow. When you consider the billions that have gone in, outflow like that, probably some profit taking or just moving to other investments, other opportunities there. But really interesting to see that large thing like that would normally make a really big headline does little to dent the momentum that is moving in this space. More on that in this WRAL News article. Back over to crypto news, and we see this CoinDesk article on Ripple. They say that banks have invested over $100 billion in blockchain infrastructure since 2020, a new report from Ripple and CB Insights. They highlight here that traditional banks took part in 345 blockchain-related deals between 2020 and 2024. The report has claimed that blockchain investment has topped $100 billion, citing over 10,000 deals, and says that 90% of surveyed finance leaders expect a major impact by 2028. We're already seeing that. They mention institutions such as HSBC, Goldman Sachs, SBI, were profiled in the report for their blockchain efforts in areas like tokenized gold, custody solutions, and secure settlement. So more on that in this CoinDesk article. Back to local news here, and another podcast that we are on, and I mentioned before, which is the Red Belly Insights one. We had a guest on there, which was Michael he's the CTO from the Australian Bond Exchange, Michael Vanderdonk. He is one of the partners for Project Acacia, which we've mentioned on this show. That's the project where we've got Red Belly Network as the first public blockchain that's being used by a central bank to test CBDCs and other digital assets. Michael, that we interviewed here, is the CTO of the Australian Bond Exchange. As we can see here, Australian Bond Exchange is one of those groups that is looking to test how we can make the fixed income markets more efficient. You can see that episode here in the links, but it was really interesting to hear about the innovations that they are pushing for in this space in any case. Regardless of whether it was blockchain or not, Michael is a tech person first and a finance person second. So he's always looking for those efficiencies. When you hear about things like T+2 and the delays that happen in this space, even the opaqueness of the markets where there's nothing centralized or there's limited stuff in terms of what is centralized, it makes you think that just how blockchain can just make things a whole lot more efficient sharing information and making it easy for retail investors to get in. Typically, it is OTC, so over the counter, meaning that it's just bilateral trades just between two people. But now that we've got things like being tested like blockchain, Project Acacia is certainly something worth following, worth tracking what Oz Bond Exchange do, because they're one piece of the puzzle in the whole securitization workflow. But more on that in this podcast here, and you can see some of the highlights. Let's just open that up.
You have an iPhone that has, if you think about it, it's its own product. If you step away from its own product for a bit and you think about it as infrastructure, you can start to see that things like Uber, TikTok, Tinder would not exist without the infrastructure of the iPhone.
What Michael was talking about there was the infrastructure that the iPhone provided. Once that was out, all of these things that were able to be created, it's the same thing with blockchain. All of these things that can be created, these efficiencies that are gained, coupling that with AI and other technologies are certainly going to make for some interesting ways that we'll do the future of finance. And rounding things out, we've also got our FEX Insight podcast that was earlier released last week. And you can see here the news that we highlight. And we had an interview with Will Remor, who is a former consultant, with MakerDAO. He was their head of RWA Tokenisation, and they were looking at this space very early on. It is not just a new thing. You can see the interview here. So let's just highlight that.
Built the very first model that is still powering actually the vast majority of risk parameterization within the Maker ecosystem today. Wow. Then we evolved from there. We spun off after kind of like raising the very first kind of like tranche of issuance in the transition from single collateral DAI to multi-collateral DAI, and then spun off another team on the RWA space that was essentially going to extend, I guess, the breadth of like what the Maker ecosystem was already doing back then in end of 2019 in the Web3 native assets.
So really interesting to hear, like way back in 2019, RWAs were being planned and spoken about. It's taken 6 years for it to really become the norm in the space. So tokenization being one side and then stablecoins on the other, and much more. Really great to see. There's a lot of great insights. We're going to bring Will back on for a follow-up episode, so stay tuned for that. And then finally, I just wanted to highlight that you may be able to get a chance to see this. By the time you're watching, hopefully I'll get this out on like either Tuesday, or maybe it's even Wednesday morning, but later this week. If it is Wednesday morning, it'll be later today that you see this. We've got the Oz DeFi Association meetup for August. That is the 27th that is on. You can see the links here. We've got about 122 people going so far. Over in Stone and Chalk, this is going to be a chance to network, to learn from industry peers and see what is going on. If you're just interested in the space, if you're working in the space, if you're just interested in networking or free pizza and beers, that's okay too. But yeah, we run the Oz DeFi Association, one of the premier groups here in Australia that is promoting and advocating for the blockchain space. We partner with others, and we've got some cool announcements coming at this one. So sign up here on this Luma link. That's it for the show this week, folks. Thank you so much for joining us. We will see more in the interview next. We are back with another episode with Will Remor. Thank you for dialing in. How's it going, mate?
Yeah, good, man. Really good. Good to be back here.
Good stuff. I didn't reach out to you, but dude, and I apologize for this. I was down in Melbourne for the weekend, but just had a full itinerary. And I know that, you've got your international work and you travel, but you've settled down in Melbourne. So for any folks that are watching this that are down in Melbourne that are going to reach out, we'll put your links in a little bit later on. But the weather was really nice down there compared to...
It was. Yeah. It was really nice. My wife says that every time that she goes up to Sydney. Lately, she's been going out like every pretty much every month, and she says like every single time it's raining, and it's not the reality here at all.
It's crazy because it's usually the other way around. I don't know what's changed, but we're under a new regime where Sydney's okay today. Actually, Sydney's got nice weather. It's sunny and stuff today. But yeah, Melbourne just turns it on after some crap in Sydney. But, regardless of the weather, there's just a whole lot of like really valuable stuff that you've got going on. We mentioned, and I think people didn't know this, that RWA is not a new concept. You know, it is something that had been thought about from the early days of blockchain technology. And was it 2019 that you were saying that Maker?
Yeah, it was at the end of 2019 that Maker started looking into it in that previous generation of RWA tokens, or like first generation of it. And it started, I guess, the story of RWAs and STOs actually go even further back to probably 2016, 2017. Some projects are really actually exploring.
STOs, for folks that may not be aware of that, what does that stand for?
Security token offerings, which was essentially the original generation done by of STOs were done by a few banks, funds, and then also some new startups in the market that were doing particularly like the tokenization and looking at different tokenization frameworks for those. The vast majority of the all early tokenization frameworks, each one was actually trying to invent their own tokenization framework, to be honest. And it was, if you go down the time machine type of Ethereum improvement proposal, you're going to see a whole set, at least 10 to 15 different frameworks that have actually been proposed.
Wow.
and passed on from back then that time of like 2016 to 2018 type of era. And to be honest, the vast majority of those are not the ones that actually are implemented today.
That is really interesting. And it was just like this trying to figure out like which standards are going to work. And even if some standard was good, unless it had the votes, it could have been a great proposal, but it just didn't have the backing. So there's a bit of like selling, you know, what could be useful there. But, you know, what was it like back then in terms of, because like right now let's think about RWA, real world asset tokenization. And a lot of the talk is around, we see a lot of things being tokenized, but the question marks around, well, is it actually valuable? Does it actually tie into legal recourse? Are there legal contracts backing it? Is it like with tokenized stocks, is it just an IOU? Or is there actually something real? And I'm not saying that it's wrong to just like even just do that first step to tokenize. That's the first step, but it's like there's more that goes beyond that. But yeah, what was it like? That's what we're talking about these days. But what were the things that was being spoken about then? You mentioned all these different standards. Was standards the key?
Were a lot of like the different projects that I think we covered it briefly in our previous conversation, like the likes of, you know, Polymath, Polymesh, T0, and others. Each of them actually were proposing standards, and then looking at different counterparties that saw value in tokenizing some of their underlying assets to launch into the market based on those specific standards, right? There was kind of like in that previous generation, again, more than 10 or so different standards of those. A lot of that actually didn't fly, didn't take up. The market didn't grow. The market was actually very, I guess, too early for it. A lot of what we call now, I guess, DeFi, high liquid markets didn't exist, right? So it was maybe a little bit too early in terms if you think from the point of view of like market infrastructure and capital, and like market infrastructure is essential for capital formation across any asset. And in this case here, like the market was just not available, right? So all that what we call today like DeFi primitives, they didn't exist at that point in time. So it was mostly about like, oh, let's tokenize for the sake of tokenizing, for the sake of actually having things on chain. But as everything, as you know, once things actually on chain, people are not nowadays. It's very clear across the DeFi ecosystem. People are not only kind of like willing to put things on chain on the primary market and then having kind of like an OTC type of relationship on the primary market, and that's it. That's all that they're going to do. They want actually to put things on chain for what? What is it that actually I gain relative to what is actually happening off chain? If all that I have is a primary market issuance and primary market redemption, sometimes actually the value of putting things on chain is just not there, right? So, and that's where I guess this second iteration, third iteration that we are living now today is building things on a completely different market infrastructure that is on top. And that's where I think it is one of the components that is making this iteration a little bit more successful. Again, let's to be honest here, we fully perfectly honest here, it's going towards success. It hasn't succeeded yet, right? Just to be bluntly clear, I think that's the direction of travel is that it's going to be successful because the market infrastructure underlying on-chain markets globally is already there, but we'll take some bumps along the road. There will probably 100%, I think it will be market failures along the road as well. But I think now the direction of travel is much more clear than it was back in that first generation of STOs.
Yeah, I agree. I think we built on the backs of giants, standing on the shoulders of giants, whatever the saying is. These things, they're not just successful now. And I think this is what I want people to realize, that there were these, whether it's figuring out the standards and other, things that will work and not work, but it's also like all the lessons that come from that. What do you think makes a really good, just given all that you know now, like hindsight is 2020, which is great. But what do you think it takes to make a really great, you said like we're on the path to success. What does success look like for an RWA project of any sort?
Okay, so I think the market is definitely converging more onto a couple of standards in terms of like RWA issuance on the primary market, and then things that are actually happening on the secondary market are, I guess, driving the flywheel of some of that success, to be honest. So the primary on the primary market now, you have, of course, the typical ERC20 free flowing kind of like token that is the most widely used is standard for Ethereum and other chains as well across the ecosystem. And there are RWAs that have been issued as pure play kind of RWA permissionless tokens or with allow lists. You have a little bit more, maybe more ring fenced, regulated standard that has been driven particularly by the Tokenisation Association that has recently been acquired by Apex Group, which is the 3643 standard that is essentially was created with a view of giving different kind of identifying different stakeholders in a kind of like in an RWA life cycle and asset management cycle of an RWA, and giving them particular functionalities. And I think there's been quite a few market operators that actually are building on that standard, but that standard is still to a large proportion of it haven't been completely plugged into the market infrastructure that I was talking about, the DeFi markets, not yet. But a lot of people have done issuance using that standard. And then there's a more, kind of like in between the two standards that are actually being used, which is the tokenized vault standards, which is being particularly used for funds in the fund management industry, where essentially kind of like allows for yield-bearing tokens to be traded traded in the market. That's 4626 standard, which is essentially yield-bearing assets that can be traded and essentially kind of like operate a little bit like as an evolution of an ERC20, right? And allows for example, like fund shares and fund units actually to be used. This is right now the most prevalent of all the RWA standards actually in the market today. And this is the one that has also been plugged in more easily into DeFi because it's ERC20 compatible, even though it's like an evolution of it because that allows for that token shares, if you will. And then is also being used not only for token shares, it's being used for most yield-bearing tokens across the ecosystem, right? So you see a lot of DeFi markets already kind of like integrating in that. And there's an evolution of that standard that I was just covering now, which is 7540, which is essentially the standard that has allowed for a synchronicity of the token itself. So for example, like sometimes there's a delay in terms of like it's non-atomic transactions between an operator utilizing the standard and the delay, particularly with the banking counterparty, but the custody counterparty, which allow for asynchronicity of the transaction, right? So that's more like an extension of that yield-bearing tokenized asset, the standard. And that one is the one that is being kind of like used by some folks that recognize that sometimes the delay is not necessarily on the activity that is happening on chain, but particularly on the activity in the markets operating off chain. And therefore, allow a delay in transactions without the the general atomicity that you have on ERC20 kind of like type of transactions.
I think it's really interesting that, these things are being created. It's we're fast tracking innovation here. We're fast tracking how quickly we are able to test transactions that at significant value or like things that just couldn't be done before because we've got programmability, but then it has to interact with the real world. So it's not until you actually test these things in the real world and you come up with, we can envisage what the problem was that people saw that led to the creation of this 7540 ERP. This is just going to continue, right? Like we're going to continue and shape how RWA works for different industries, like whether it's real estate or it's carbon credits or it's like something else. Even the tokenization of things that just were, making it tokenizable so that now you can give access to people that wouldn't have had access to, say, for example, fixed income. And the whole securitization kind of process that we're seeing as part of our not centralized project for Project Acacia and the other 24 pilots and proof of concepts. But, what are the interesting things that you're seeing being tokenized? Like you're at the coalface, and not only just, some people like myself, we're newer to this, but you've seen it over time. Whether it was something that was looked at back a few years ago, or something that you're seeing more recently now, what are some of the interesting things being tokenized?
There's all sorts of crazy experiments, to be honest, that have happened, and I've seen probably like some of the craziest ones that I've seen in the early days that, of course, they haven't realized because I don't even know if there is actually a on-chain market ready for it. But I've seen people tokenizing like things like Rolex watches for trading value, maybe kind of like some limited editions of some Rolex watches that they would like actually to use as on-chain collateral across lending markets, for example. Another one that is probably out there and definitely a few years away from some sort of like realization in mass is people tokenizing things like the specific chemical components in the production of wine. So, for example, trying to reverse engineer kind of a specific type of cepage or in a wine production, and then saying this is absolutely unique. So, for example, like a Chateau Lafite or some like high-end wine that costs, hundreds of dollars and not hundreds of thousands of dollars actually a bottle, and trying to reverse engineer that molecule and the patent of that molecule and use that as collateral for trading in kind of like as NFTs or the like in the trading markets. Of course, that kind of stuff is very exoteric. But I guarantee you, like just, 3-4 years ago, people were coming to protocols, where I was receiving some of these applications all over the place. And it was kind of like people were taking this absolutely seriously. And it's like, okay, uh, how do you create markets for these things on chain, where most of the traders in these markets were absolute degens, right? And who's gonna pay? Who's gonna provide market infrastructure, say like price discovery for things like this? It's very, very difficult to create markets for these esoteric products. But of course, I mean, that all the way into the future, these are not necessarily the markets where the money flows are going, right? Definitely are not. A lot of it, the activity in the last few years has been very much in the highest liquid parts of the fixed income markets, because it's the biggest low hanging fruit, really.
I think low hanging fruit is definitely one thing. There's also these like so-called Arturo, my colleague that you know well here, and also co-founder of Oz DeFi. He points out these dark markets, these markets where you may have, and I would argue this is kind of low hanging fruit because it's a market where it hasn't been digitized. There's a lot of like invoices or streaming of like revenue flows going through there. And it's either because it's inaccessible to retail traders, or it's just been not a non-digitized kind of market that could benefit from efficiency, or a mix of different things and components that lead it to being an attractive market to tokenize. If people are looking for, new things to tokenize, whether it's esoteric stuff like the patents for a chemical compounds, to do with the wine industry, what do you think makes a good kind of tokenization project? Like if you were to look at it, I'm not saying from an investor lens and stuff, do your own research, folks. This is not investment advice, of course, but like what makes something attractive to you? Because either you're interested in it, you want to work on that, or like, what makes something good in terms?
So I think the core, I guess, value proposition in terms of RWA markets that actually pay, not only myself, but others actually pay attention to, are those that manage to transform liquidity from a highly illiquid off-chain market into a maybe more liquid or better liquid on-chain market. I think this is kind of like the optimum like the future. And one of the areas where I see that that is increasing is definitely on the private credit space. So there's a significant amount of hedge funds and shadow bank operators that actually are operating now in the private credit sphere, where of course, because of all of the post GFC regulations, traditional commercial banks actually couldn't operate, either because there was actually too much risk, or their risk-weighted assets in other Basel multiple iterations kind of like frameworks actually prevented them actually from going that way. So that has been taken by private lenders in the private credit markets. And a lot of those actually have essentially higher lockups and higher lockups, potentially some duration risks associated with some of those lockups, and a lot of private credit operators are actually looking for ways in the blockchain space to essentially kind of like, what if we could do some sort of like liquidity transformation alongside with like the DeFi markets, that we could actually make this asset class a little bit more liquid, so actually I can attract more flow, even if they're forfeiting away some of the yields on that primary market, but actually transforming this in actually being more liquid. There is a big portion, because people don't realize it, but private credit market now is close to $10 trillion globally. It's a huge market, and is only been growing because actually the compliance and regulatory burden on traditional brick and mortar commercial lenders is nowhere reducing. Like there's a lot of people even kind of like starting to say like, hey, we have actually to change Basel 3 and Basel 4 regulations because traditional commercial lenders cannot lend with the, all of the restraints on capital requirements and risk-weighted assets, and the way that actually those risk-weighted assets actually are calculated. All of that market is being taken on by private credit. So definitely there's a lot of operators out there servicing this market, and a lot of them actually are starting to look into ways of bringing some of those assets into the blockchain world.
I love it. I think that there's that it's a good way to look at it, like especially that it just makes you wonder, and maybe someone's done some researchers, as we said before, like you came from that quant space back in traditional banking. Before, we used to look at numbers all the time in research, whether it's the data side of things, if you're on the buy side or the sell side. But I just feel like there is this big move. Stable coins and RWA was a big topic. Private credit, like, definitely is this huge space, like liquidity there that could be unlocked if only it's sat on programmable money, is pretty massive. Tokenization makes a whole lot of sense. All the chaos that happened before of figuring out what standards were, of like how these things best work and interact, and all of the features that are necessary for a real kind of like good project. I think we will need to dive into more of this in some future episodes with you, Will. But mate, thank you so much for the valuable lessons here. I think people should get a lot of good takeaways from this. And we're going to be doing some more events down in Melbourne, man. So we'll have to come down and see you for Oz DeFi for the work that we do there, and we'll have to get you up on stage, and we'll put people in touch with you. Links are in the show notes from the last episode, but just for this one, Will, thank you so much. We'll put your links down below, and if any people want to like reach out, they can do that.
Yeah, awesome. Thanks very much. And I hope people actually get some value out of some of these interactions. There's a lot more under the hood here that we could have covered. We haven't even actually touched on the things like BTC backlending and other areas of the RWA markets that we can probably go into, and also a little bit more into what is it that is actually happening under that DeFi ecosystem. Where is it that actually these RWAs are flowing into, and what is it actually happening across them, both from the spot as well as the futures market that's already happening. But anyways, I'll leave this as a teaser for a future conversation.
Perfect. No, that's good. I love it. You're already bleeding into what we will cover in like a future one. But BTC back, yeah, that is a massive part of what could be unlocked. We'll talk about all of that and more in a future episode. Thank you so much, Will.
Thanks, mate.
Some really great stuff there from that one. If you want to get in touch with our guest, please do check the show notes below here, and we'll speak to more of folks like this, whether it's exchanges, whether it is folks that are working the space, those that are new or those that have had a storied history. There's a lot of great insights when it comes to collaboration, sharing, and getting them on the podcast. I'm Mark. Thanks for your time. This is FEX Insights episode 13, and we'll see you next week.